All right, welcome. Think of this as your personal coaching session on financial reporting. We're about to slice right through the complexity of 3 absolutely crucial accounting standards. And I promise, by the end of this, you'll have a super clear framework to make the right judgment calls every single time. Let's dive in.
So, let's just jump right in with a classic exam question, shall we? This is the kind of thing that really separates someone who just memorizes rules from someone who truly understands them. It seems simple enough, doesn't it? But the right answer? Well, it all comes down to mastering a specific standard we're about to cover. Stick with me, and you'll know exactly how to nail this. Okay, so before we can even think about touching the numbers, we have to ask the single most important question in all of financial reporting. Is this business actually a going concern? Will it still be around for the foreseeable future? This right here is the bedrock, the absolute foundation laid out in IAS 1. It's the "Are we still in business?" standard.
So what is this going concern principle? Well, at its heart, it's the simple assumption that the lights are going to stay on. It's the whole reason we value a factory based on what it can produce, not what we could get for it as scrap metal. It is the default setting for pretty much all of accounting. But what happens when that assumption starts to look a little shaky?
Because in the real world, businesses face storms. And when those problems get big enough that they cast real doubt on the company's survival, we can't just ignore it. This is exactly where the term material uncertainty comes into play, and it becomes your professional duty to raise the flag.
And here's the crucial part for you. Your main responsibility here is disclosure. When there's a material uncertainty, IAS 1 demands that you are crystal clear about it. Now, you don't necessarily change all the numbers to liquidation values, but you absolutely have to lay out the facts for investors. You've got to describe the problem, explain what management plans to do about it, and make it very, very clear that the future is up in the air. Honestly, this is a huge test of your professional integrity.
Okay, so if IAS 1 is about the state of the business, like a snapshot in time, then our next standard, IAS 8, is all about how we handle changes across time. You should think of it as the official rulebook for accounting's version of time travel. It tells us exactly when we need to go back and fix the past, and when we just need to adjust for a different future.
Now, this is really cool because it basically splits the entire world of accounting changes into 2 neat categories. On one side, you've got things we either got wrong or just decided to do differently now, like fixing a big error or changing an accounting policy. For those, we have to go back in time and restate the old numbers. That's called retrospective. But on the other side, you have our predictions, our best guesses, our estimates. When we get new info that changes an estimate, we don't change the past. Nope, we just adjust from today, moving forward. That's prospective.
And this little timeline makes it super clear, right? A retrospective change, like finding out last year's inventory count was way off, it reaches back in time and corrects the past. But a prospective change, like deciding a machine is probably going to last for 8 years instead of the 10 we first thought, that change starts now and only impacts today and the future. Getting this distinction right is literally the entire game when it comes to IAS 8.
Now, let's talk about that tricky period, that little window of time between your balance sheet date and the day the financial statements are actually signed, sealed, and delivered. It's like this weird accounting limbo where things can happen that directly affect the numbers you're just about to publish. IAS 10 is your map through this minefield.
So, let's look at a very real-world example. Imagine a company was being sued at its year-end, December 31st. Nothing was settled. But then, in February, before the accounts are finalized, they agree to settle for $1 million. So, what do?
So what's your call? Do you go back and change the December 31st numbers? Or do you just mention it in the notes? This is a direct test of your professional judgment. Think about it for a second. Is it an adjusting event or a non-adjusting event?
Okay, let's walk through the logic. The one question you have to ask yourself every single time is this: did the condition exist at the reporting date? In our case, yes. The lawsuit was absolutely there on December 31st. The settlement in February, that's just new, better evidence about the value of that condition that already existed. And because the answer is yes, it is an adjusting event. You have to go back and adjust the year-end financials. It is always about when the root cause happened.
We have covered a lot of ground pretty quickly here, so let's boil all of this down into a simple, powerful playbook you can use to structure your thinking when you are under pressure. Think of this as your mental checklist.
This right here is your playbook. 3 standards, 3 core questions. For IAS 1,
Is there material uncertainty about going concern? If yes, the impact is disclosure is everything. For IAS 8, is this a new guess or an old mistake? The impact, you either go prospective or retrospective. And for IAS 10, did the condition exist at the year end? The impact, it's either adjusting or non-adjusting. Master this framework and you will master these judgment calls.
And that really brings us to the final and maybe most important point. The standards we've just talked about, they're the tools. They tell you how to do things. But actually applying them takes more than just technical skill. It takes professional integrity. Knowing these rules is one thing, but having the courage and the ethics to apply them to present a true and fair view, that's everything. That's the real challenge and, frankly, the real value of what you do. So the question is, where will you draw the line?